You pulled up to the gas station this morning and paid $2.98 for a gallon. Enjoy that number, because by the end of this week, it could be gone, and it might not come back for a very long time. The war in Iran didn't just kill people, it killed something else too. Something that touches every single American every single day. It killed cheap gas. And today, I'm going to show you exactly how this war is going to hit your wallet, your grocery bill, your rent, your flights, and why even if you don't own a car, you're not safe. Let's go. First, the numbers. And I want to be precise here because this is important. Before the US and Israel launched Operation Epic Fury on February 28th, oil was trading at around $67 a barrel. That's West Texas Intermediate, the American benchmark. Brent crude, the global benchmark, was sitting at $72.87. By Sunday night, Brent was at $79 a barrel. That's an 8% jump in less than 48 hours. And by Monday morning, it was still climbing. US crude hit $71.19, up 6.2%. Brent surged to nearly $79.31, its highest point in more than a year. And here's the thing, analysts say this is just the beginning. Citigroup, Moody's, Rice University's Baker Institute, they're all saying the same thing. If this conflict drags on, we're looking at $100 a barrel, maybe more. Now you might be thinking, okay, oil went up, but how does that actually translate to what I pay at the pump? Let me explain it simply. Every $10 increase in the price of a barrel of crude oil adds roughly 25 cents to the price of a gallon of gas. That's the math from Ken Medlock, Senior Director at the Center for Energy Studies at Rice University. He said it clearly, if the price of oil goes up, the price of gas goes up in lockstep. So do the math with me. We're already up about $7 from Friday. That alone could add 15 to 18 cents at the pump. If we get to $90 oil, which is entirely realistic, you're looking at 50 to 55 cents more per gallon than you paid last week. If we hit $100, you could be paying close to $3.50 or $3.75 nationwide. And in places like California, New York, or Illinois, you could be looking at $5 gas again. Patrick DeHaan, the lead analyst at GasBuddy, put a specific number out on Monday morning. He said some individual gas stations could be charging 30 cents more per gallon by the end of this week. Some locations, up to 85 cents more. Let me put that in real money. The average American drives about 15,000 miles a year. The average car gets about 28 miles per gallon. That means you buy roughly 535 gallons of gas a year. If gas goes up 50 cents a gallon, that's $267 more out of your pocket per year. Per car. If you have two cars, that's over $500. If gas goes up $1, you're looking at over $1,000 more a year just on fuel. And that's before we talk about everything else. Because here's what most people don't realize. Gas prices are just the most visible part of the oil price shock. The real damage runs much deeper. Think about everything that gets delivered to your house, your grocery store, your pharmacy. Every truck on every highway runs on diesel. And diesel, the fuel that moves 70% of all goods in America, already jumped 38 cents per gallon wholesale on Monday morning alone. 38 cents in one morning. When diesel goes up, shipping costs go up. When shipping costs go up, every company that moves goods has a choice. Absorb the cost and kill their margins, or pass it on to the consumer. And almost always, they pass it on to you. That box of cereal, that case of water, that Amazon package, everything gets a little more expensive when diesel spikes. Mark Zandi, chief economist at Moody's, spelled this out on Monday. He said every sustained 1 cent increase in the price of a gallon of gasoline increases national spending on gasoline by nearly $1.4 billion over the course of a year. 1 cent.
Times that by 50 cents, that's $70 billion a year being pulled out of Americans' pockets and put directly into the energy market.
And Zandi made another point that I think is really important. The people who get hit hardest aren't the wealthy. It's lower income households. He said exactly this. Higher gasoline prices are particularly hard on lower income households because they spend a higher share of their budget on gas.
These are people who are already under serious financial pressure. They can't just absorb a $50 or $100 swing in their monthly fuel bill. Now let's talk about why this is happening, because understanding the mechanism is key to understanding how bad it could get. The Strait of Hormuz. If you don't know what that is, you need to. It is the single most important waterway in the global energy economy. It's a narrow channel, at its narrowest point just 21 miles wide, between Iran and Oman at the southern end of the Persian Gulf. And through that strait, every single day, flows roughly 20% of the world's entire oil supply. 20%. Every tanker coming out of Saudi Arabia, Kuwait, Iraq, Qatar, the UAE, and Iran itself has to pass through that strait to reach the rest of the world. And right now, that strait is effectively closed. Iran declared it closed after the US-Israeli strikes. And even before the formal declaration, the market was already reacting. By Monday, tanker traffic through the strait had essentially halted. Shipping companies and their insurers looked at the situation: attacks on vessels, electronic jamming of navigation systems, missiles flying overhead, and they made the only rational decision. They're not risking it. At least 6 of the world's leading cargo shipping companies announced over the weekend they were halting or diverting ships that were supposed to sail through the strait. Data analytics firm Kepler reported that satellite navigation systems in the area were being disrupted. The UK Maritime Trade Operations Centre warned of elevated electronic interference and reported attacks on several vessels on both sides of the strait. The Strait of Hormuz isn't just about oil either. It's also the primary exit route for liquefied natural gas, LNG, the fuel that heats homes and generates electricity across Europe and Asia. European natural gas markets have already surged more than 20%. And here's a twist: the United States is now the world's largest exporter of LNG. So, ironically, if European demand spikes and US LNG prices rise, that can feed back into American energy costs too. Now, what's the worst case scenario? And I want to be honest with you here because I think it's important to present both sides. The worst case? Oil tops $100 a barrel and stays there for months. That would push gas prices to $4 or higher nationally. Diesel stays elevated, food prices climb, airlines raise ticket prices. The inflation rate, which had been coming down, reverses course and starts climbing again. The Federal Reserve, which was expected to cut interest rates at its June meeting, holds off. Borrowing costs stay high. The housing market, already strained, gets squeezed harder. Credit card rates stay elevated. And Americans heading into the midterm elections in November are angry, not just about the war, but about the cost of living. The best case? The conflict is short. Iran's new leadership, whoever that ends up being, agrees to a ceasefire within days. The strait reopens. OPEC Plus steps in to fill the supply gap. Saudi Arabia has already announced it's boosting production by 206,000 barrels per day in April. Strategic petroleum reserves from the US and allies get released to calm markets. Oil pulls back to the 70s. Gas prices bump up 20 or 30 cents and then come back down over the following weeks. Which scenario plays out? Honestly, nobody knows. And that uncertainty itself is part of the problem. Luis Costa, Citigroup's global head of emerging market strategy, wrote in a note on Sunday night, "Historically, geopolitical oil shocks fade quickly, but if this episode lasts longer, markets may see extended volatility." The Atlantic Council published an analysis from energy expert Landon Durrance, making the case that people shouldn't panic yet. He argued that regional infrastructure remains intact, that Saudi Arabia and other producers have weeks of inventory
positioned around the globe, specifically to cushion disruptions, and that the world economy operated and grew under oil prices north of $100 a barrel during the Iraq War from 2003 to 2011. His conclusion: markets can tolerate a spike. What they can't tolerate is prolonged uncertainty over trade flows through the Strait of Hormuz. And that's exactly the strategic dilemma right now. Here's the political dimension, because this is a politics channel, and you need to understand why this matters beyond just your gas bill. Trump has spent his entire second term celebrating falling gas prices. In January, gas prices were down more than 7% from a year ago. That was a genuine win for American consumers, and Trump talked about it constantly. We're bringing energy prices down. Drill, baby, drill. It was one of the central promises of his campaign, and he delivered on it. This war threatens to erase that entirely. Brian Gardner, chief Washington policy strategist at Stifel, a major financial firm, wrote on Monday morning, "Voters have already been concerned about the economy and affordability. A sustained increase in oil prices could be a risk for Republican candidates in November." Think about that. The midterm elections are less than 9 months away. If Americans are paying $4 a gallon at the pump when they walk into the voting booth, that is a massive political liability, regardless of how the military operation is going. There's also a wild card that could work in Trump's favor: Venezuela. Energy Secretary Chris Wright told CBS News on Friday that tankers filled with Venezuelan oil are now arriving in the U.S. This is oil that came online after Trump ordered forces to capture former Venezuelan President Nicolas Maduro back in January. Trump has said the U.S. plans to export 30 to 50 million barrels of Venezuelan oil in partnership with American energy companies. That additional supply could help offset some of the Iran-related disruptions. But refiners buy oil a month or more in advance, so that Venezuelan supply won't show up at the pump for weeks. The price spike is happening now. So where does this leave you? What should you actually do? First, if you're planning to fill up your tank, fill it now. Prices are still relatively low compared to where they could be in a week or two. Every analyst I looked at today said the same thing. Prices are moving higher in the short term. The only question is by how much and for how long. Second, if you're making any big financial decisions in the next few weeks, refinancing, taking out a loan, making major purchases, factor in the possibility that inflation could tick up and interest rates could stay higher for longer. The Fed meeting is March 18th. Most economists expect them to hold rates steady, but if energy prices keep climbing, a June rate cut starts looking less certain. Third, watch the Strait of Hormuz. That's the single most important number right now. Not the oil price itself, but the tanker traffic. If ships start moving through the strait again, the market will calm down quickly. If they don't, if this blockade holds for weeks, everything gets worse. The bottom line is this: this war is real. The economic consequences are real, and they are coming to your gas station, your grocery store, your heating bill, and your Amazon cart. Whether you support the war or oppose it, whether you voted for Trump or against him, the Middle East is on fire. And when the Middle East burns, Americans pay for it at the pump. That's the story. I'll be updating you every single day as this develops. If you're not subscribed yet, hit that button right now, because this story is moving fast and you don't want to miss what comes next.